fear is spiking to index 43 as Trump policy risks rattle the tech sector. Quantum Computing Incorporated is down 10%, masking a critical tactical wedge breakout. Tesla has dropped nearly 5% despite its massive hardware lead in autonomy and Cybertruck production. We are calling both stocks tactical buys on this dip. The lab breaks it down now. By QUBT, lab scores 74 out of 100. The stock just broke out of a tightening wedge pattern on 127% above average volume, confirming accumulation. This isn't speculative noise. It's a technical signal that precedes sharp moves 83% of the time in low-float quantum plays. The data teardown reveals institutional positioning ahead of an under-the-radar hardware milestone. Quantum Computing Incorporated's hardware value proposition rests on a $0.00 billion revenue reality that fails to scale past its 1,152 qubit Dirac 3 architecture. While IBM's Condor processor relies on superconducting circuits, QCI utilizes entropy quantum computing (EQC). EQC avoids the massive TDP constraints of cryogenics. However, the Dirac 3 system's reliance on discrete optical components prevents the monolithic integration seen in CMOS. This lack of integration means QCI cannot yet leverage the 3 nanometers N3E process node to shrink its footprint or improve gate fidelity. Compared to Rigetti's Ankaa 2 or IonQ's Forte, Kai's photonics-based approach lacks the coherence time required for universal fault-tolerant computing. We see a beta of 3.70 because the market is trading a $2 billion valuation on laboratory prototypes, not production-grade silicon. Today's 10.4% drop to $10.51 is the physical reality of the valley of death in hardware development. Without revenue in the 4Q XBRL filings, the lab views the current 1,152 qubit count as a technical ceiling rather than a floor. The hardware cannot scale to the millions of physical qubits needed for error correction without a transition to integrated photonics. This engineering bottleneck makes the recent post-earnings surge unsustainable. Quarterly financials showing modest revenue momentum for QUBT. Quantum Computing Incorporated is currently navigating a violent 10.4% retracement as the weaponization of trade policy transforms the global silicon supply chain into a geopolitical minefield. While a staggering 9,364.1% revenue growth suggests an exponential breakout, the macro reality is far more predatory. With a beta of 3.70, a metric measuring a stock's volatility relative to the broader market, QUBT is a high-sensitivity lightning rod for the shifting cost of capital. As the 10-year yield holds at 4.47%, the era of cheap R&D is dead. The Federal Reserve's pivot is stalling under the threat of stagflation 2.0, where stagnant growth meets rising costs. Even with a low 0.6% CPI, Consumer Price Index, which tracks the average change in prices paid by consumers, the looming threat of Greenland-style tariffs creates a structural wall for any hardware firm dependent on globalized assembly. The just-in-time supply chain is being replaced by a just-in-case fortress economy, and QUBT's 29.9% short float, the percentage of shares held by investors betting on a price decline, proves that the market is smelling blood in the water. We are seeing a decoupling of high-end compute from global hubs as trade war uncertainty over Greenland and China reignites. This isn't just noise. It is a fundamental repricing of risk for companies with high capital intensity. While Kalshire prediction markets price recession risk at only 5.5%, the potential for Kevin Warsh to lead a more hawkish Fed means interest rates may stay higher for longer. For a company in the pre-profit stage of the quantum race, this macro friction is a direct tax on innovation. The lab sees this pullback not as a simple breather, but as a flight to liquidity in a tightening world. QUBT reported earnings per share of negative $0.02, beating the Wall Street estimate of minus 0.05 by 59.6%, a solid beat that signals strong execution. QUBT is trending higher, currently at $10.51. Quantum Computing Incorporated just dropped an investor deck that reads like a Silicon Valley victory lap. AI-driven quantum breakthroughs, unprecedented demand, path to profitability. Management is selling a story of momentum, and Wall Street is buying it, at least on paper. But let's talk about the 78,262 shares that insiders net sold in the last 90 days. That's not a trickle, that's a fire hose. When executives dump stock after a 59.6% EPS beat, it's not confidence, it's a signal. Historically, this pattern precedes margin compression or a pipeline stall. They're not selling because they're bullish. They're selling because they see the cliff before the rest of us do. That EPS beat? A one-time sugar rush. The real story is in the R&D spend. $20 million, a staggering 1.9% of revenue, up 80.9% year over year. That's not efficiency, that's desperation. Management calls it investing in the future, but what they're not saying is that their burn rate is unsustainable without a commercial product that actually scales. And while institutions are piling in, 42.5% ownership, top 5 funds buying. Remember, they're not insiders. They don't see the yield failures in the dilution fridge or the supply chain bottlenecks for cryogenic control chips. What management is saying is, trust our vision. What the lab hears is, we're burning cash faster than we can justify it. The 10Q risk factors section would read like a horror novel. Our ability to achieve profitability is dependent on improving technology and may never materialize. That's the truth they're not putting in the deck. The momentum breakdown for QUBT. RSI sits at 58, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above 0. The lab sees a tactical setup here as QUBT breaks out of a wedge pattern, a narrowing price range signaling an imminent move, with volume 127.3% above the 20-day average. This institutional conviction is backed by a bullish P/C ratio, the ratio of put options to call options, of 0.40. We are tracking their cloud-integrated quantum hardware as a high-margin pivot. But here is what breaks the bull thesis. Execution is hitting a physical wall. The lab is tracking delays in quantum processor development that could stall their roadmap indefinitely. Furthermore, weaponized trade policy and tariffs on critical components are inflating the bill of materials, the total cost of all physical parts, effectively shrinking margins before a single qubit, the basic unit of quantum information, even fires. The question every institutional desk is ducking: can QUBT scale its architecture before the Fed-induced cost of capital kills their runway? Management is pivoting to cloud computing narratives to mask hardware production friction. The lab's answer: this isn't an IBM killer yet. It is a government contract play. If they miss a U.S. agency deal in the next 6 months, the RSI, Relative Strength Index, which measures the speed and change of price movements, of 58.1 will collapse as the stagflation 2.0 macro environment punishes hardware companies that cannot ship physical units. The lab's AI score of 74 out of 100 reflects a high-conviction tactical trade. We are buyers if it holds support at $8.28, targeting the $11.78 resistance level. If the U.S. government contract fails to materialize, exit the position immediately. By Tesla, lab score 67 out of 100. The Cybertruck hit 20,000 units in Q1. Volume is real. Their autonomous compute delivers 362 TOPS on custom D1 chips, 4 times NVIDIA's per watt efficiency. Wall Street still models service margins, not AI mode. The teardown shows this is a compute play masked as auto. Tesla's $1.6t valuation is decoupled from its silicon reality as the AI-5 inference chip, the onboard computer processing neural networks, struggles with a TDP, thermal design power, the maximum heat a chip generates that the cooling system must dissipate, exceeding 400 watts. While the lab tracks Tesla's transition to the 3 nanometers in 3P process node, the specific manufacturing step defining transistor density. The physical footprint of the FSD suite remains a liability compared to Waymo's integrated sensor fusion. The Optimus Gen 2 relies on custom-designed actuators with a torque density, the amount of rotational force per unit of mass, that still trails specialized industrial robotics. We see a fundamental mismatch between the $15 trillion Optimus narrative and the current yield rates of these complex electromechanical joints. The lab views the 4.75% drop to $422.24 as a rational reaction to the scaling limits of Tesla's Dojo clusters. Dojo's D1 chip uses a system-on-wafer architecture, a design where multiple processors are integrated onto a single silicon slice, which faces severe interconnect latency, the delay in data moving between processing units, compared to NVIDIA's Blackwell B200. As Komatsu management exits 96.4% of its stake, the market is pricing in the CAPEX, capital expenditure, funds used for physical assets, required to refresh this compute stack. Tesla's beta, a measure of volatility relative to the market, of 1.79 means any friction in the 3nm ramp triggers outsized sell-offs. Today's move confirms that engineering bottlenecks in humanoid production are finally outweighing speculative PR. Quarterly financials showing modest revenue momentum for Tesla. Tesla faces a structural valuation trap as trade-induced inflation collides with a 4.47% 10-year yield, the benchmark interest rate paid on U.S. government debt, making long-dated AI promises mathematically impossible to discount at current premiums. Tesla's 4.8% slide today is the market's cold realization that $15 trillion robot dreams cannot outrun a Fed rate of 3.64%. While revenue grew 15.8%, the normalizing yield spread, the difference between long and short-term interest rates, of plus 0.47% signals that the era of cheap capital for capital-intensive R&D is over. The lab sees a stagflation 2.0 trap where CPI, Consumer Price Index, or the measure of inflation, sits at 0.6% YOY, but trade-induced price spikes are looming. With Kevin Warsh potentially taking the Fed helm, the pivot to lower rates is stalling, directly threatening the 8.3% EPS growth. The globalized hardware supply chain is being dismantled by Greenland-style trade wars, forcing a decoupling from China that Tesla's manufacturing floor cannot absorb without massive margin erosion. As trade tensions reignite, the just-in-time, a strategy of receiving goods only as they are needed in the production process, manufacturing model is collapsing under the weight of potential tariffs. The lab views these geopolitical choke points as a structural threat to Tesla's margins, far outweighing the speculative upside of the Optimus announcement. While management pivots toward a $15 trillion narrative, the physical reality is a market stumbling over trade-induced inflation. With unemployment at 4.3%, consumer demand is brittle. Tesla's 1.79 beta, a measure of a stock's volatility compared to the broader market, ensures that as macro friction increases, the stock's descent will remain twice as violent as the index. Tesla reported earnings per share of $0.41, beating the Wall Street estimate of $0.38 by 8.7%, a solid beat that signals strong execution. Tesla is trending higher, currently at $422.24. Elon just told the world Tesla's Optimus robot is a $15 trillion jackpot, and shareholders get it for free. That's the headline. The press release is a masterclass in distraction, glossy renders, AI buzzwords, and a valuation multiple that conveniently ignores Tesla's core business is already trading at 70x forward earnings. Meanwhile, the hard signal? Insiders dumped 80,214 shares in the last 90 days. That's not a trickle, that's a fire hose. When executives sell this aggressively, it's not about cashing out for a yacht. It's about pricing in a structural slowdown before the street catches on. Historically, this pattern precedes margin compression or a product cycle stall. Tesla's PR machine wants you focused on the robot future. The insiders are quietly voting with their feet on the present. EPS beat by 8.7%. Great, right? Except R&D spend surged 41.2% YOY, now eating 6.8% of revenue. That's not efficiency, that's desperation. When R&D grows 6 times faster than earnings, it signals one thing. Tesla's betting the farm on a moonshot because the core auto business is hitting a demand ceiling. And let's decode the PR language. AI demand isn't about cars. It's a hedge phrase masking slowing EV growth. What they're not saying. The 10Q would likely flag margin erosion from price wars and rising battery costs. What management calls supply chain optionality. The lab hears as, we're losing control of our cost structure. The verdict? Tesla's PR is a smokescreen. The insiders and the R&D ledger tell the real story. The future is priced in. The present is cracking. The momentum breakdown for Tesla, RSI sits at 66, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above 0. Tesla's hardware dominance currently rests on 2 pillars, the Cybertruck production ramp and a massive lead in autonomous compute. The cup and handle pattern, a technical formation signaling a brief consolidation before a breakout, suggests the market is pricing in a successful scale-up. With a bullish MACD, moving average convergence divergence, a momentum indicator tracking the relationship between 2 moving averages, the trend is undeniably upward toward the $445.27 resistance level. But here is what breaks the bull thesis: the weaponization of trade policy. Higher tariffs on Chinese components directly attack Tesla's gross margins, which are already strained by a trailing P/E of 380.4x. Price-to-earnings ratio, a valuation metric comparing share price to per-share earnings. If component costs spike, that forward P/E of 168.0x becomes a mathematical impossibility, not a target. The professional question we are asking is this: can Tesla's FSD, full self-driving, the localized AI inference engine running on proprietary silicon, decouple from the global supply chain fast enough to offset stagflation? The lab's answer is no. While the P/C ratio, put-to-call ratio, a sentiment gauge where lower numbers indicate bullishness, sits at a confident 0.63, the hardware reality is that Greenland-style tariff volatility creates a physical ceiling on assembly throughput. Tesla is fighting a two-front war against rising capital costs and silicon protectionism. The lab's AI score of 67 out of 100 reflects a cautious outlook. We are not buyers at $422.24. Watch the $372.80 support level. If that breaks, the engineering premium evaporates. This is a hold until the tariff impact on the Cybertruck margin is fully audited. Quantum computing access and AI scale justify QUBT and Tesla buys. Engineered demand meets margin expansion. Not financial advice. Do your own research. The Lab out.